Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. On today's video, how you can set up a solo 401k plan in 2023 or 2024 for free. Yeah, for free. And this is not a marketing video. This is a video that's going to review and dissect the Secure Act 2.0 and specific tax credit provisions that you would think would seemingly not apply to a solo 401k, but mistakenly or not, the IRS goofed. And a special tax credit that can give a small business or sole proprietor the ability to generate a credit of up to $1,500 to establish a solo 401k and simply just check a box for auto enrollment in the plan docs. Yeah, you don't have to do anything. You literally just check a box and you'll get a $1,500 tax credit that will more than cover the cost of a solo 401k and compliance. So this is something that I've known about for a while, and I haven't gone public on it because when the Secure Act 2.0 came out, the end of 2022, it took time to kind of dissect the 80 or so retirement-related provisions, over 400 or so pages in Secure 2.0 that was specific to retirement accounts. So when people actually digested the language in Secure 2.0, which was obviously drafted by the Ways and Means Committee of Congress, and then the Senate Finance Committee were drafted, and then there would be a meeting of the minds, and then the final version of the bill would be sent to the president to sign, which President Biden did in December 2022. In the past, most tax credits for adopting a 401k, like a startup credit or incentives to make employer contributions, have always been focused on ERISA 401ks, meaning 401k plans that have non-owner employees, and more specifically, non-highly compensated employees. Essentially, employees that don't own 5% or more of the company and make less than $150,000. The goal and intent of these tax credits makes sense, right? We want to get more businesses to adopt a 401k. Why? Because the more businesses adopt a 401k, more their employees are going to participate, meaning more people will save for retirement, more money in the retirement system. People will have more money when they need it later on. Social Security will hopefully be around, but it won't be as vital to many of these folks because they're going to have their own retirement funds. And in the United States, we have a private retirement system. We're in charge of making contributions to our own retirement account. We can't rely on the government. This is in Sweden or Finland. So if we don't make contributions to our own retirement account, all we're going to have at retirement is Social Security, whether it's here or not. We pray it will be, but that's just not going to be enough money to live and have a sustainable quality of life when you're older. So saving in the U.S. retirement system is vital, and because it's a private system, it's up to us to do. So credit the government, both the Democrats, Republicans. It's the one area that is full bipartisan support. The Secure Act 2.0 was almost passed unanimously. The Ways and Means Committee is bipartisan, same with the Senate Finance Committee. It's run and chaired, obviously, by whoever's in power in the House and Senate, but there is cooperation and collaboration. Okay, it's not like Washington politics as usual. And that's why things get done, and that's why both parties have the interest of the American people at heart. And this is a great example. So tax credits to help and incentivize businesses, especially small businesses, which make up the chunk of new hires in America, to incentivize them to offer 401ks. So in Secure Act 2.0, there's a number of tax credits that have been focused on 401ks, okay? And this has always been the thing. In the past, whether it was Secure Act 1 back in 2019, or Secure Act 2 in 2022, these credits have always been focused on 401k plans that have, or businesses that have non-owner employees and non-highly compensated employees. Okay, and that's why I really haven't talked about startup tax credits for SEPs or Simples or solo 401ks because they didn't exist. They did not relate to self-employed plans or plans that did not have any non-highly competent employees. So I just didn't spend a lot of time doing videos, blogs, or podcasts on them because they just weren't relevant to my client base, which is generally IRAs, people that want to self-direct, or sole proprietors, small business owners with no employees that want to set up a self-directed solo 401k plan to make huge contributions. For example, 2024, 69,000 or 76,500. Maybe borrow 50,000 or 50% of their account value, whatever's less, and obviously self-direct their investments, whether it's real estate, precious metals, crypto, stocks, whatever the case may be. So I never really focused on ERISA plans because that really hasn't been where my client base has been focused. But Secure Act 2.0, something happened. So I'm going to go through the three main tax credits for 401ks. And then the last one, I'm going to focus on something called the auto enrollment credit, which really should only apply to ERISA plans. I mean, and I'll explain why, but it seems, and it really seems to suggest the way the language was written, the fact that the word non-highly competent employees were omitted from the language would state that even a solo 401k plan could take advantage of the auto enrollment credit of up to 500 tax credits a year for 3 years, or a total of $1,500, which, as I mentioned, would pay for your solo 401k. So let me start up. I'll just start up with the new 401k startup credit, which is essentially a $5,000 startup tax credit. It does not apply to solos. It applies to regular 401ks with employees, SEP IRAs or simple IRAs or defined benefit plans that have non-highly competent employees. Employees that own less than 5% of the business and in 24 make more than $150,000. So the startup credit, hasn't been very relevant to the self-employed because it doesn't help self-employed folks. It doesn't provide them any benefits to establish a plan because that $5,000 credit does not apply to plans that don't have any non-highly compensated employees. The second one is the employer contribution credit, which would provide a credit of up to $1,000 annually per employee if the employer is making employer contributions on behalf of that employee, so long as that employee doesn't earn more than 100K, right? So the idea is let's incentivize companies to give profit sharing. And if we give profit sharing to non-highly compensated folks, the government's going to give you a tax credit of $1,000 per, which is super, super cool. And it's a great credit, but it doesn't apply to a solo 401k plan because it only applies to a business that has non-highly compensated employees. Okay, and a solo 401k plan doesn't. Why? In order to establish a solo 401k plan, there are two eligibility requirements. Number one, you got to have a business. Okay. Number two, the most importantly, the business cannot have any full-time employees, and full-time means 1,000 hours or 3 consecutive years of 500 hours or more. So none full-time employee, okay, and 3 consecutive years or 1,000 hours. Non-owner employees. Now, 1099 spouses, they do not count as employees. But any business that has an employee that works more than 1,000 hours or 3 consecutive years of 500 hours or more that are non-owners is not eligible to set up a solo K. And that's why those folks would just set up a regular 401k plan. And the advantage of having employees is obviously your business is growing. That's great. But you also can get the startup credit of up to 5K. You can also get the employer contribution credit if you're making profit sharing contributions because you're going to have non-highly compensated employees. That's the key, right? The whole point of these credits, which we'll get into in a minute, why the auto enrollment credit is so wonky. The whole point of these credits is to incentivize businesses to set up plans and offer benefits to rank and file employees, right? Non-highly compensated, people that make less than 150 and don't own more than 5% of the business. I get it. That's good policy. Very good policy. We all agree with that. Let's get to the auto enrollment credit, which is the heart of today's video. And this is the fun. So auto enrollment is something that was in Secure 2.0. It's going to be required in 2025. And basically what auto enrollment means is, hey, if you hire an employee you got to automatically enroll them in the 401k plan, which I 100% agree with. Statistics are super clear. If you auto-enroll folks in a plan, they're not going to opt out. They're just going to stay in the plan. And if you set them at, let's say, 3% of their salary, the money's going to roll out of their paycheck. It's going to go into the 401k, and they're not even going to know about it. And when they look back in a year, 2 years, 5 years, 10 years, they're going to be quite happy that they have tens of thousands of dollars in their 401k, and it was put there really unknowingly to them. Why? Because it auto-enrolled, and they maybe thought it was just more tax going to the government, and they're like, oh, it's only whatever, $100 a pay period, or $50 or $20 a pay period. It's probably some stupid tax, whatever. I can't argue against it. And they don't even know it's a part of their 401k. Whereas if you make employees actually opt into the 401k, it's a lot more difficult, because then someone may say, you know what, that's $100 a week or $50 a week. I could use that for my rent or grocery bills or my car payments. And you know what, like, I'll worry about it in a year or in 6 months, or I'll figure it out down the road. I want the cash. And the statistics and reports are very clear that if you auto-enroll people, more people will stay, more people will save. It's a higher saving percentage, which is better for everyone. So they're going to make auto-enrollment required in 2025, and then there'll actually be gradual increases in terms of where you start that person, whether it's like 3% or 5%. Every year they're auto-enrolled up to a certain cap. Now, the employee can always say, no, I'm out. I don't want to be in the 401k, or I want to just do 1%. That's fine, right? It's up to the employee. The government can't force you to put away money in your plan. Maybe they should, but they can't. But at least when you're auto-enrolled, you're in. And now it just takes more work to opt out. We all know with like subscriptions, like my wife subscribed to Peacock like a year ago for my kid. He wanted some show. And I found out a year later, when there was a football game on between the Dolphins and Kansas City, I was thinking about actually ordering Peacock to watch the game because I love the Dolphins and my kids love the Dolphins. I realized we were already subscribed. We've been paying every month, $9.95 or whatever, to Peacock. We never knew, because my wife subscribed. They gave like a free trial, and we were supposed to opt out, but of course we never did. So we've been paying Peacock for the last year. Same with 401ks. If you auto-enroll, more difficult for the employee to just opt out. So what's the auto-enrollment credit? It's basically saying, listen, if you have a 401k plan and you check the auto-enrollment box on your plan and you actually auto-enroll your employees, we'll give you a $500 credit just for doing that, just for checking a box and basically getting your employees, your new employees in, auto-enrolling them in the 401k. This will be required in 2025, but if you do it in 23, 24, 25, you do it for 3 years in a row, we'll give you a $500 credit just for doing it. Okay, flat 3. Amazing, right? Why are credits valuable? This is a good point. A lot of people don't realize the difference between a deduction and a credit. A credit reduces your tax liability dollar for dollar. So if you owe the IRS $25,000 and you have a $5,000 tax credit, you only pay $20,000 in tax, right? So it's a dollar for dollar reduction in tax liability, super tax advantageous. A deduction just lowers your tax base, meaning I made $50,000 and I gave $5,000 to a charity, I pay tax on $45,000. It's not reducing my tax liability dollar for dollar, just reducing my tax base. So you can see a credit obviously is way more valuable because it's going to actually reduce the amount you have to pay to the IRS. So the fact that they're offering us credits and not deductions for simply auto-enrolling employees is just free money. It's just literally $500 free for 3 years. Now, when this was drafted, a lot of tax and ERISA attorneys, and myself included, were basically like, there's no way this applies to solo 401k plans. No chance. Why would it? No other 401k startup credit, employer contribution credit, Secure Act 1, Secure Act 2, nothing else applied to solos. Why? Because the solo 401k is the business owner and part-time people and other business owners or their spouses. So why would the IRS or Congress or the Senate incentivize business owners to save for themselves? Like, why would you need to auto-enroll yourself, right? It's your plan, right? Like, you don't need to auto-enroll yourself. You know if you're going to save. What's the point? It just didn't make sense. Like auto enrollment are for employees. They're not for yourself. If you set up a 401k, the intent is to obviously use the 401k. Why else would you set up a 401k if you don't want to use it? So obviously you're going to be incentivized and interested to enroll yourself and be a part of it. So when this was drafted, people were like, well, this credit is not possibly available to solo Ks. The hang up was that all the other credits, startup, the employer contribution credit that I mentioned, references non-highly compensated employees. Okay, this credit does not. The word non-highly compensated employee is nowhere in the language for this auto enrollment credit, which some people said, well, why? Maybe there's a reason. No one knows. Okay, the bottom line is the IRS or the House, the Ways and Means, the Senate Finance, whoever drafted this provision, I think just screwed up. They literally just screwed up and did not include the words non-highly compensated employee. I don't think they intended for business owners to auto enroll themselves and get a $500 credit for like literally checking a box that doesn't apply to that. Because no solo 401k plan needs an auto enrollment feature. Because just you or your spouse or a couple partners. There's no employees. There's no non-highly compensated employees in a solo K. It's impossible. Because then if you did, you'd have a regular 401k. Or maybe they're part-time, but they're not eligible anyways. So why would you have an auto enrollment feature that isn't applicable to a solo plan? And on top of that, why would you give anyone a $1,500 tax credit over 3 years to check a box and auto enroll themselves when it's literally pointless? I don't know. But I've reserved judgment. I've not gone public really till today. I just don't believe it. Now, I also work with two pension companies called Pension Investors. And if you're looking for like combo cash balance plans, defined benefit plans, they're the best. Been around literally since ERISA, the 70s. And they have thousands of plans that they administer and design. And I had months and months of conversations with them. And these folks, some of them have been doing this for 35 plus years, actuaries, brilliant. And, the attitude is like, Adam, on its face, this credit applies to solo Ks, but like you, we don't understand why the word non-highly compensated employee was not included in this definition or this language here. It doesn't make sense because no solo 401k would auto-enroll themselves. And I kept saying, yeah, I agree. It just doesn't make sense. And that's why I didn't really focus or blog about it or talk about it in 23 at all. I just didn't. And then, the last couple of weeks, I've just, for some reason, just end of the year, people looking for credits, deductions, and I just spoke to an ERISA attorney. It's like en passant, just thinking, and he was saying, you know what, Adam, I've actually started talking to clients about the auto enroll credit and basically saying for solos that it seems like it is available. I was like, whoa. I kind of agree, but I've been scared to say something just because I don't know if that was the intent. I don't know if the IRS will come out with rules down the road. But now that it's been over a year and it's been a whole tax filing season, I'm ready to go public and say, yes, I do believe that if you have a solo 401k and you start one for 23 or 24, let's say, you can get a $500 tax credit for 3 consecutive years or $1,500 by checking a box on our plan docs, which we will do for you for free. That will auto enroll yourself since you have no non-highly compensated employees, and you'll get the credit. Now, how do you get the credit? You basically just file form 8881. We can work you through that. And that's where you would attach that to your business tax return and you would get the credit at $500. Now, it's not 50 million. $500 for 3 years, that's $1,500. Our solo 401k plan costs about $1,000. Sometimes there's discounts, but about $1,000 and generally $399 a year for us to administer, consult, record keep it. If you get a $1,500 credit, then you're basically getting a year and a half, 2 years free because the first year the consulting's included. So if you add the $999 and the $399, that's 2 free years of the solo K free. So you could set up a solo K with us for free and get a year of free tax consulting free on your solo 401k by doing nothing, by just watching this video and listening to podcasts or blogs that I'm going to do on this very specific topic, because I'm ready. I'm ready to go public with it. I just was really cautious. I'm conservative, just being, a tax lawyer. I've just felt, hey, I'm not sure this is what the IRS intends, but it seems like this is what's going on. So that is the answer. You cannot get a tax credit if you're a solo K for the new startup credit or the employer contribution credit, which I get, makes sense, but you can get for the auto enrollment credit, which is shocking, surprising, but it's real. And it's a real tax credit that lets you set up a solo 401k for free. Okay. Plus get an extra year of consulting with IRA Financial. So it's exciting. Who would have thought the IRS would literally let you set up a plan for free? And not just any plan, a self-directed solo plan. And why is a solo plan so good? And why have I written multiple books on it? And why am I so gung-ho on solo 401k plans? Well, for the following reasons. Number one, you can put away $69,000 or $76,500 if you're over 50 and 24. Okay. By the way, you can still set up a solo 401k plan for 23 in the 24 year, thanks to Secure Act 2.0, up until your business follows its return. Okay, you got plenty of time. Don't worry. But if you want one for 24, get started, right? Why wait? You can start putting away money. So the first is the high contributions. The second with a self-directed plan is you can do traditional investments like stocks or ETFs, mutual funds. You can also do alts like real estate or hedge funds, investment funds, gold, cryptos, hard money loans, flipping, whatever. You can do almost anything you want except two things. You can't buy collectibles and you can't self-deal, right? You can't buy a house and live in it. Otherwise, you can do it. Third reason to go solo. You could borrow up to $50,000 or 50% of your account value, whatever's less. Use it for any purpose too. 5-year loan, but you get to pay yourself back. Prime interest rate is now 8.5%, but you're paying yourself back instead of a credit card company, and that's an 8.5% rate of return. Pretty good. Next one is the mega backdoor Roth. You can put away $69,000 or $76,500, dollar for dollar, all Roth. So almost 10 times a Roth IRA. Now, IRA Financial is one of the few plans that will let you do it. Next one. If you're a real estate investor, secret weapon. You can use leverage without a tax known as UBIT, unrelated business income tax. So if you get non-recourse loan to buy real estate, if you did it in a self-directed IRA, you pay up to 37% tax potentially on the net profits associated with the loan. Now, if you want to use a lot of leverage, that UBIT tax can be a little bit higher. In a solo K, you can literally leverage up your property as much as you can, and there is no UBIT tax under Section 514C9. So if you're a real estate investor and you have some self-employed income, or it's important to note, and I should have said this earlier when I was explaining the eligibility for a solo 401k plan, you don't need to be fully self-employed, right? You could be an executive at a business and do stuff on the side. Maybe you consult on the side, or you're a tutor on the side, or you sell stuff on the side, whatever the case may be. It doesn't have to be your full-time gig. You can have a side gig. You drive for Uber, DoorDash, whatever. I was talking to an Uber driver a few days ago, and he was saying he makes almost $100K driving Uber. I mean, he works like 6 days a week. You can make a lot of money doing gig economy work, and you should know you can still set up a solo K. And even if you do Uber on the side, just on weekends for fun, you can still set up a solo 401k to divert some of those funds into a solo K and get tax deductions or just save tax-free in a Roth. So there's a lot of amazing retirement planning opportunities available. You just got to understand the rules. Very easy administration. If your solo has less than 250K, you have to file nothing with the IRS. If you have more than 250K, we will handle all IRS funds. Last but not least, asset and credit protections. 401ks have better asset and credit protections than IRAs. If you're a client of IRA Financial, we handle everything: the setup, the record keeping, the admin, tax reporting, everything. We literally wrote the book on the solo 401k. We're the best at it. So if you are looking to set up a solo K, you're interested in getting it for free. who wouldn't? I mean, you literally can set up a solo K for free. I know it's crazy, and I keep repeating it, but it's true. Contact us. You can reach out, call us, IRAFinancialGroup.com, 800-472-0646. You can chat us, find us, email us, social media, YouTube, which is, I think I'm really, really proud of our YouTube channel. If you haven't subscribed, you should. It's free. And we post, 2 to 4 videos a week, 3 podcasts a week. I go live once a week, maybe more, and you'll get notified and you can check out the content. But if you are interested in self-directed retirement, IRAs, 401ks, alternative asset investments, tax strategies, how to open a business safe tax-free, how to do founder stock tax-free, Roth conversions, how to set up a 401k for free. If you're looking to be a smarter investor, check out the channel. I think you'll enjoy it. Also, if you have comments, leave them. If you like what you hear or watching, please thumbs up would be really cool. I like getting those better than getting bad comments. So not that I get a lot, but I can handle constructive criticism. I'm always trying to get better. I'm just a tax lawyer. I'm not a professional actor. So I do my best, but the most important thing that I focus on is content. Okay, making sure the content's 100% accurate, it's delivered properly and clearly, and the audience understands it and benefits from it. Those are my goals. So if you have comments on that or ideas, questions, let me know. But otherwise, that's it. Auto enrollment credit, Secure Act 2.0, available for solo plans. You can set up a solo plan for 23, 24, and beyond. Get a $500 tax credit up to $1,500. Set up a plan for free, including an extra year of consulting, all for free, by literally setting up a solo plan. And by setting up a solo plan, you are going to put yourself in the direction of becoming a hopefully 7-figure tax-free millionaire. I mean, that's the goal. If you put away 10,000 plus for the next 10 to 15 years, you will have over $1 million when you retire, and likely more. It's just math, right? If you just do compounded returns and do simple math, you will understand that. So the fact that the IRS is letting all of us set up a plan for free, okay, and getting all these tax credits by simply filing a form, pretty cool stuff. So just wanted to kind of focus on it. I don't think a lot of people are aware of this. I have been, but I've been quiet on it just because I just wanted to make sure that I had the support of my team, that this was something that made sense and that actually was something the IRS would give credence to, and they do. I think they did mess up. I don't think that was their intent, but I do think that's what is at stake. So before I leave, I just want to run some numbers by you because I think it's important to know and understand the power of the solo plan. If you're going to get something for free, right, you got to understand the benefits, right? If I walk around, if you're a vegan and I give you hamburgers for life for free, it's not worth anything. Retirement plan is valuable to all of us, especially if you're self-employed. So here's an example, okay? Let's say you put away 10K a year, okay? And you start at 35 and you put 10K a year from 35 to 70. You'll have $2.2 million tax rate. Okay, let's say you did it in Roth. Let's say you started at 40. And this is assuming an 8% rate of return, which is way under, well, not way under, but if you look at the S&P 500 over the last 100 years, it averages about 10%. So an 8% rate of return is conservative. If you started at 40 instead of 70, you would have 1.47. But let's say instead of 10K, you did 15K a year, okay? And you still start 40 to 70. You would have 2.039 million, okay? So 15K a year from age 40 to 70, 8% rate of return, you got over $2 million. All for setting up a solo K, all for free. Okay, let's throw some other numbers. Let's say you just want to put away 5K a year. From 30 to 70, 8% rate of return, only 5K a year, you'll have 1.9 million. Let's say a little more. Maybe you want to do 8,000 a year. Okay, 35 to 70, 8% rate of return, you're going to have 1.89 million tax rate. Okay. It's all real numbers. I'm not making this stuff up. This is math. This is compounded returns. Don't trust me. Trust Albert Einstein, who said compounded returns is the eighth wonder of the world. It's true. It works. It's just basic math. It just takes patience, consistency, and good habits. And now the IRS is giving you a plan for free. So there's no excuse. If you're out there watching or listening and you have any self-employment income, you can set one up for free. We will help you file the tax credit form 8881 to get the $500 credit for 3 years. That's $1,500. We'll help you do it, and you will get the plan plus 1 year of consulting for free. It's a no-brainer. What are you waiting for, right? And you get the benefits of high contributions, mega backdoor, borrowing up to $50K, self-directed. The plan can be used for traditional as well as alts like real estate, and we'll help you design it, consult, administer, and IRS report. It's a no-brainer. You literally have to do nothing. We'll do everything for you. It's free, and you can save and generate millions of dollars for you and your family tax-free. So I hope this stimulated you guys to jump on the solo 401k bandwagon. I'm excited. I'm not eligible because I don't have a side gig. I wish I did, because I'd be calling IRA Financial right now. That was a selfless plug. I'm sorry. I will be doing more Rob's videos. You know what? I'm actually speaking at a conference on Monday on Rob's, but I'm going to see if they can tape it, and if so, I will try to broadcast it. If not, maybe next week I'll do a YouTube live on the Rob. So thank you, Pete, for that question. Otherwise, appreciate you guys hanging out with me today. It's a really exciting, important topic, and I'm looking forward to helping a lot of you guys set up solo 401k. So thank you again for watching, and if you have questions, comments, leave them, and I'll talk to everyone again next week. Thanks, and have a great day.